Gentlemen, ready?
Yes.
All right. Okay. Thank you so much for being here with us. My name is Jason Ma. I'm the CEO and Chief Mentor of 3EQ, which is my family business. I also am building another super exciting tech company. Ron Reddy is a good friend of mine, and we met a number of times in Silicon Valley and also at the B20 summit in New Delhi late last year ahead of the G20 Leader Summit. That was a total blast. And Dinesh, who is the CII president here, and we are all amongst friends. So thank you very much. It's an honor and pleasure to be here with you today. I understand that the audience here is really primarily entrepreneurs and investors, VCs, some family offices, angels, I'm sure. And the title of this talk is Family Office Trends. Now, in Silicon Valley, and I've been living here for 51 years, my favorite bad joke is that I look like I just graduated high school, but my kids are 27 and 24. As a tail-end boomer, so I've seen a few things, including lots of yellow lilies in the South Bay way back, to all the powerhouse, the big tech and the little tech and the investors that's pretty much so dominating in the tech world. And we are probably in one of the most influential regions in the world. So there's a lot of things to be excited about, especially when it comes to AI and deep tech. Now this talk is about trends in single-family offices. In Silicon Valley, the voice of the VC, the voice of a few of the successful entrepreneurs, pretty much drown out a lot of the other types of categories when it comes to investment. But not a lot of people talk about family offices so much in Silicon Valley. So I'm going to disrupt that a little bit today. Now, lots of single-family offices by definition, and these are like literally single families or one individual with their family with a net worth, median net worth of about $0.6 billion. That's how wealthy they are. They prefer to set up a single-family office, which is a small or a larger, just a group to manage your wealth. You know, wealth is about wealth preservation, wealth growth. Wealth preservation is very important. You don't want to lose your money, like Warren Buffett. Rule number one, don't lose your money. But you also want to save tax and grow your wealth through different vehicles, different strategies and tactics and all that. So, SFOs historically have been, some of them depends on, some focus on real estate only, some focus on the traditional investment, and some are into alternative investments, including VC, direct investing, PE, hedge fund, etc. And lots of these single-family offices are, of course, LPs, limited partners, in lots of VC, PE firms, and all that, and some into hedge funds as well. But what I'm seeing is I get invited to speak quite a bit. In my family business, I'm known as the chief mentor, or award-winning chief mentor, next-gen leaders, as well as being a rainmaker, investor, and a speaker. And I get invited to speak a lot in these family office summits. In fact, I just chaired the one in Napa, in the Hamptons recently, by Opal Group, family office and private wealth, kind of a summit. Very just spectacular. It was so much fun. I have learned so much over the years. One trend that I'm seeing is that more and more wise SFO, single-family offices, are going more and more direct when it comes to direct investing. Now, some of them lost their shirt, but that's quite normal. And a lot of them, of course, put in money as an LP. But one trend that I'm seeing is that they're going more and more direct. Why is that? One reason is they have a bit more freedom. They are unshackled. They have a lot more freedom. They don't have the limitations of the typical LP-GP agreement, and they are free from the politics, and they also get to see a bit of a reduction in the fees, and they have patient capital. You're going to hear that quite a bit. Permanent capital, patient capital. That means that if I'm the SFO principal means you're the owner, you might hire or you don't have to hire a CIO, depends on the size and all that. Like I work directly with the principals, and these are typically the matriarchs and patriarchs, the guys who make the money, And I get to coach and mentor some of the next gens as well, high school kids, college kids, and elder next gens. It's so much fun. And so that the patient and permanent capital, you're gonna hear about more and more of that. They just don't have to get, they're not limited to the typical 7-year, 10-year relationship with a VC firm, VC fund, and capital calls, and sometimes, unfortunately, I know so many billionaires and centimillionaires and ultra net worth entrepreneurs and investors, right? The politics some of the GCs play and all that. And so some of the SFOs are a little bit, I'm wondering what I could go direct to invest in a tech company, to follow someone, or I could lead, or I don't even have to lead. I could use convertible notes, I could use SAFE. So it's a bit more freedom. Another thing that I'm observing is that I remember a good friend of mine. He's one of the 3 co-founders for Carlyle Group. I'm sure you guys know about that, right? One of the biggest PE firm. So Dan and Aniello, I could never pronounce his name right. He knows my younger daughter pretty well because he lectured in Wharton before. My younger daughter used to be the co-president of the Wharton FinTech Club, and he said pre-COVID that human capital is actually more important than financial capital. Think about that, okay? Now, of course, that was before Gen AI got into the game here. And we're going to talk about that quite a bit. So AI, how to use AI to augment, in addition to investing in AI companies. Of course, AI agents are in fashion right now. So human capital, trust relationships, etc. And then we're going to also talk a bit about, in this panel, about using AI, on how AI could augment decision making, right? I came from industrial engineering and operations research from Berkeley Engineering. I graduated in 1984. That's all we do is optimization, using tools. My first job, 1984, I was already a data scientist. We were already talking about AI back then. Back in TimeNet, Telenet were the precursor to the commercial internet. So quite a bit of a history there. All right, with that said, I'm gonna swing straight to, I kept it in 7 minutes in my talk, which is good. I'm gonna go straight into a conversation with my esteemed panelists. So what I'm gonna do is that I'm gonna ask each esteemed panelist, Ken Goldman, Michael Sikorsky, and also Matt Oguz, to spend 1 minute each to describe what's important to you. And then we're going to enter into the conversation. Ken, take it away. 1 minute.
Yeah, I've had a long career. Actually, it was funny, I was talking to Jason. He beats me by 1 year. I've been in the Valley for 50 years. He's been 51 years. So I've had a long career as a CFO. Many of you probably know me from either Yahoo, Siebel, Fortinet. I was involved with several companies that we collectively took public as a CFO. I've been on, over the years, well over 40 boards now, if you include them all, public and private. Now I'm on 4 public boards, a few private, a few nonprofit boards. Very active investor. Also, by the way, I should mention I'm an investor with the Golden State Warriors. So I missed last night's game being there, but I'll be on Friday. As I said earlier, I'm an active investor. Do a lot of venture investing, do a lot of private equity investing. I do probably a dozen or so directs, which we'll get into in the Q&A, in terms of direct investing as well, in addition to the funds and so forth that I work on, and try to keep an active life. I should also mention I ran the family office for Eric Schmidt called Hillspire. I ran that for 5 years. Left there about a year ago, and that was sort of the culmination of my career, so to speak, in terms of full-time roles. And I got to know Eric when he was on the board of Siebel Systems when I was CFO.
Right, Ken is certainly super well known as a Silicon Valley legend, as both an entrepreneur, senior executive, and investor, right? SFO. So.
Just trying to get a good microphone now to work.
My background is tech founder, sold four tech companies, started my family office, single family office in 2016. And to just be really clear, like, what am I looking for all the time in the family office is access to insights, So one of the reasons we love to go, for example, this trend of going more direct, when I'm through a fund, I don't get any pattern recognition. I don't understand what's going on with all the founders in the deal. And then the second thing that we love to look for is some asymmetry in the deal. So if you even think about access to insights, it's also asymmetry of information and asymmetry in the deal. So sometimes I'll even give you an example. The deals that we say instantly yes to are kind of like tails I win and heads I win big. Not a lot of venture deals come that way, but if you just kind of want to get into the head of a family office allocator, that's what we're kind of looking for. And then I'd say as a person on the planet, I want to actually support the people that we're investing in. And I think about our family office. Internally, we think of it as a canvas for talent.
Does this one work? Okay, great.
We're good.
Wonderful. Wow, I mean, my true esteemed co-panelists here have said most of it. I have nowhere near the fame or the success here at the rest of this panel, but I run direct investments, and I also run all equity capital markets participation for a family office-backed firm. And within that, we've participated in over 40 IPOs and very anxious, excited to get into more, hopefully, once this IPO lull kind of goes away. Our private portfolio has over 10 companies that are getting ready to go public. Again, we've been waiting for that IPO window to open. Other than that, my background, I come from investing, and I continue to invest across almost all asset classes, including real estate. But I don't do anything with real estate anymore. Over the last 10 to 12 years, I've been handling all of our venture investments. So looking forward to discussing things more as Jason lays them out.
I'm going to add something on direct investing. As I said earlier, I sort of said I did about a dozen a year. I see those from two angles. One is through people I know being in the technology. My whole career has been technology, so I'll know a lot of people from technology. The gentleman before us was talking a lot about Sequoia, so a few months back, Doug Leone recommended a company I invest in, so I trusted him. So a lot of what I do is really trust in people. Another individual came to me, Dave Welch. He was one of the founders of Infinera. He has a new company ongoing, so I invest in his company. So a lot of my investing when I do directs is really through my own network of folks that I trust, or someone refers me in. Again, there's someone I trust. The other deals I'll do with generally are SPVs, single purpose vehicles, or special purpose vehicles, however you want to refer to them. Again, from a venture firm I may be involved in, and they do co-investing, and they'll get me, like I did a couple with Silver Lake, which actually is a private equity firm, but they were more like venture-backed deals. And so I'll do deals there again where they've vetted the deals. I think it's very hard as an individual to do enough due diligence. People always want to snow me with the data rooms, and but I think as an individual it's hard to figure that out. So I go a lot by instinct, trust in the people, or if it comes to a venture firm that I respect, trust in their diligence as well.
Right. If I could add to that before Michael and Matt, you chime in. And the previous speaker talked about Roelof Botha. We know him. I remember Roelof and I were one of the three panelists beating up on Stanford students a couple of years ago in a panel. That was kind of fun. And after that, Roelof publicly said, my biggest failure, my biggest mistake is a failure of my imagination. So like what Ken mentioned, people trust that gut feel in addition to data. And in addition to typical other metrics, kind of your timing, market, team, product, idea, et cetera, is hyper important. That said, Michael, what's important to you in direct investing? What are you, direct investing, also investing as an LP, what's important to you? What do you focus on?
Yeah, so one of the cool things, just to kind of talk about family offices for a second, because it's a single family office, you have no constraints. There's no rules, there's no thesis, you can do whatever you want. So one of the things that so it's kind of like a bad answer. As a family office person, you can do whatever you want, whenever you want, however you want. So is that kind of smart? Not really. So over time, you kind of have some processes. So even as a single family office, we have something called an investment committee. So like if VCs normally have like a partner meeting, and then we have rules, okay? So if it's a friend's kid, 25 grand, do it, don't even do due diligence. We can do $250,000 investments without going through IC. Anything above, we go through IC. So that's kind of how we think about it. But when you think about like what we're looking for us, it's normally, again, like something that's like Kent's point about like when it comes from the inside track and you've known the person and you already invested in them, those are the no-brainers. But what we try to do, and we're not great at it, but we want to have the people who we don't know still have a shot to talk to us. Because one thing that's really hard, and I have a lot of founder empathy, if you think about my life, I basically was a founder forever, up until 2016. I want to find out, how do you get into a family office? How do you break through a family office? How can they do all this due diligence? I have something like 29 different asset classes. So just so you guys understand, in my world, when it comes to tech, I do it, and almost in every single other asset class, I have a manager that I've employed to do it. Because if you just think about even like from a perspective of like a family office person, so I'm supposed to be good at multifamily real estate and storage and triple net, how about I can? And then wait a sec, how do I do hedge funds? Oh wait, are one of them long, short, 130-30? Wait, is it an options trade? Like you just it's just too much. So for me, I get most excited when I see a passionate team who loves to build software, and then this will kind of be like a weird sentence, but like when I can tell they're poets. So when I feel like they're poets, then I like love them so much. Because imagine this, okay, someone phones me up and goes, hey, do you think I should start a company? My answer is instantly, no. Okay? What poet would phone up and be like, I have these poems to me that have to come out. So if there are people I don't know and they're coming to me and they're early, then I just basically do a poetry test. And that's kind of how then they can go through our process.
So our process is actually quite calculated. When I first came here to Silicon Valley in 2007, I was to visit a friend of mine that I went to school with, and he was a professor at Stanford at the time. And I started looking into, you know, what people do here, how do they invest? You know, venture capital firms, some of them go back 30, 40, 50 years. I think the industry itself goes back to the Rockefellers, but you know, at the time I noticed that most of the investments made were, you know, yes, there were committee meetings and so forth, but most of them were highly gut feeling, you know, what we call heuristics-driven decisions. And I happen to have studied decision theory in grad school, so you know, I was familiar with models that they used in other asset classes, hedge funds or you know, what they call quants in Wall Street. They've been around for quite some time by then. They would look at risk-return profiles. They'd try to calculate check sizes. I knew people in the bond industry, for example, both in New York, out here in Los Angeles, PIMCO, and they would do these calculations all the time, and they tried to really figure out the odds of what they would expect to get over a period of time, and then calculate a number of checks that they would write in the check sizes. And I wonder if this would be possible in the venture capital industry. So I started looking into, first of all, you know, how can I improve the selection model? I thought I would never have, you know, the wherewithal, or, you know, one day I could be under the weather and decide against the company just because of that reason, or the next day. Essentially, Herbert Simon says we're all, a rationality is bounded. He won the Nobel Prize for this, which means we either cannot take in all the information that's relevant, or even if we take in all the information, we may not be able to calculate all the potential outcomes. Fortunately, today, some AI, you know, they're domain specific. They can help with this, but at the time, there was none of that existed in the venture capital world. So I wrote a few articles. I sent it over to TechCrunch. Nobody knew me here. TechCrunch published those articles. And, you know, I think the first one that I wrote now goes back to 2014. It's been, I still get emails, and a friend of mine is now doing his MBA over at Wharton and showed me a photograph, and they were talking about venture returns, and it was the graph that I published. And so today you look at all the venture capital firms, and every single one of them, they have quants working there. So it wasn't only my contribution solo, there were a few other people, but naturally we all went from the gut feel driven to, is it possible to do a little bit more math? Is it possible to build selection models? What if we keep our discussions and debates on the model, but not on the company, and we can change the models, but when we feed the company through it, I don't want to end up in a situation where my partner or somebody says, there's something about that company that I like. What is it? I personally can't live that way or can't function that way. So we are a lot more careful. We cherry pick. I cherry pick equity capital markets all the time. I tell Goldman, well, cherry pick. You know, we are selective in our investments. Directs is a lot of work. I really don't want to do this in the long run. But today there's fantastic opportunity. There's fantastic deals, particularly in the healthcare AI space, which is where we're deploying capital today, and also space tech. Those are the two themes. We try to pick themes that are far correlated than one another, so in case one of the investment fails, it won't take the whole house down. So that's kind of how we operate, how we invest. The results play out however they play out. So on a good day, of course, everybody's happy. During down times, people could get upset and so forth. But our general thesis is always try to be calculated and recognize our bounded rationality, and not that we're superior than anybody else, and try to invest that way.
I'm going to add, when I was listening to that, I think you have to be careful on direct investments in particular to think about the exit strategy. The reality is, there's a number of reasons why the IPO market's down. I mean, the overall market's at all-time high, so you might wonder why the IPO market's down. It's because many of the companies got overinflated during the 01-02 time frame, and they're trying to reach into the evaluations. Also, many of the IPOs that came out in 01 did not do well, so many of the public investors feel scars from that time. The other thing is, it's sort of the adverse selection. People don't talk about this a lot, but many of the best companies don't see a need to go public. I can think of companies like Canva, SpaceX, Stripe, Databricks, because they're flush with cash. They can raise as much cash as they want in the private markets. They can create secondaries so the insiders can sell some through the secondary market. And so they don't need to go public, and therefore it's harder and harder for venture and, frankly, individuals to get liquidity there. So I think you have to be very careful that it's like this year I was reading something where there's 2 times as much invested as exits in venture. And I don't know when that's going to change. It has to change at some point, otherwise the math doesn't work. But I think you have to worry about the exit strategy. M&A has been tough. We all know the reasons why, politically, whatever. So I think you have to be thoughtful and circumspect, thinking about, the one thing I'd say is when I go into PE investments, PE firms, they always go into an investment with an exit strategy. They always think about how long they'll take, how to exit it, and so forth. I don't find venture investors doing that. And so therefore, I was just listening to one of the VC, a fund I'm involved in. It's on dissolution now because it's already passed its several years of extensions, and it still has a number of, in theory, good companies in theory, but it just tells you how long it takes now to get venture investments mature, and therefore you have to look at the IRRs of that versus just going in the public market. So I would be very careful to get too infatuated on doing direct deals. Absolutely, go ahead.
Yeah, I think Ken's 100% right, but I also just want to make this point about the trend because the companies aren't going public. Like, to give you an example, Microsoft went public at what, 129 million market valuation? And then what, Amazon did 350 million? Now imagine your family office, and if I could, I would much rather, and this is not a rude thing, why would I not rather just pick up companies in the public market and sell them? Now today you have what, the Magnificent Seven, S&P 500, super concentrated. So there is a trend that family offices want to figure out how to get access to that, which is why they then want to go into VCs. And then I'll just tell you another thing in family office, at least how we work. Lots of times we'll make a bet on a VC to just get in, but we'll do like a math, like 1 to 8. Okay, and then people are like, what do you mean 1 to 8? Okay, if I'm giving $1 million to VC to get in, I'm internally planning $8 million to decide the cherry picks out of the first 20 that I want to go into. And then I have a chance maybe to be direct on the cap table, start building the thing. Yes, the VC, the GP will take some fees from me, but now I'm being strategic, like, okay, it's a lot of work to go direct. Someone's got to do it. Now, the one positive part of a family office is that I don't care if it's 20 years to get out, right? This part of the bag that we're doing is super, super long because, I mean, even as a founder, I was one of the people who, I sold my company to ThoughtWorks, and that's like how old this was. They didn't go public for 19 years since I sold my company, and I sold 0 shares along the way. So I'm like wired that way. Like I'm wired like, yeah, I know I did that investment. I'm like, it's okay, my kids will have it in 20 years, right? So I have a different brain. But then when you think about all the other stuff, then it means I have to have really nice liquidity on other stuff. So that's why sometimes I don't have stuff down the middle.
Yeah, I think, first of all, it's very important that more companies go public. That's the reason why stock markets exist. Stock markets don't exist because people want to go and trade, buy and sell from each other. The stock market started with a company going public. I believe the East India Trading Company in the Amsterdam Stock Exchange, and the second one was Bank of England. So, as the French say, the raison d'etre of the stock markets is the IPOs. And the total size of the US public markets is about 50 trillion, maybe 55 since it's been going up. The total investable assets of everything in the world is about $1.6 quadrillion. So the stock market's still much, much smaller in comparison to everything else combined. So I expect both the market to go up over time as, you know, there's more liquidity out there, but that fueling, if it came from all of these amazing companies that some of the people here in this conference are working on, you know, down the street, across the street, this area and other places around the country and literally the world, and fuel the public markets, then I think we have a conversion where once you were in the alternative assets and now all of a sudden you're in a traditional liquid asset class, you don't have to sell your shares, you can hold on to them. I think Hillspire is still holding on. Eric's holding on to Google shares, right? Maybe he sells a few here and there. But he can, if he wanted to, tomorrow morning. So that's very different than a company where you have to wait for a tender offer, you have to wait for something else. I'm curious, how many people here are entrepreneurs and how many of them are angel investors or anybody that writes a check?
Okay, entrepreneur first, raise your hand. Angel investors? VCs? Family offices?
All the above.
All the above.
All the above.
Yeah, so if you're an entrepreneur, talk to your lawyers, talk to your CPAs, plan for an IPO. You know, if you're especially past Series B, it's a good time, as of course my friend here would know, working on your valuations and so forth, and set the stage. And maybe run the company as if you are a publicly traded company with the same or standards close to that. And I think that would make things much easier as these companies progress. I mean, other than that, I don't know what else to add to the equity capital markets at large. But one thing that most people don't know is these conversations all happen still manually and over the phone and in person and in in-person meetings. And these markets are still very much an interpersonal relationship-driven place for everyone. So we need to get to a positive mindset with the choppy waters of the market down, hopefully lower interest rates, And then from there, I do expect to see more activity. Maybe not the rest of this year because we're waiting on the transition. There's still some question marks around the presidential transition and so forth. But once that's done, 2025, we'll see how the markets move.
I would say it's good to see so many entrepreneurs here. I mean, technology, certainly for 50 years that we talked about, but especially the last 10, 15 years has been the place to be. I mean, you look at the market cap, the 7 of the top, 10 highest market cap companies are all technology companies, either based in San Francisco area or Seattle. So it's a great wealth generator. I think the difference today versus 2021 is that there is capital available still, like a lot of, I think I was reading 300 billion of dry powder in VCs, but it's being more discriminately spent. And so you'll have to be, which I think is good. I think companies in the 21 period got, too fat, dumb, and happy and spent too wildly. And I see over and over again, actually someone used the term unicorps yesterday. I hadn't heard that term before. So instead of unicorn, unicorps. So we're going to have quite a few of those, that companies that took way too much money, spent too fast, and now have to resize themselves. So I think but I think for those entrepreneurs, there is money available. There's very good funds available, very good venture firms available, and many of them that still have plenty good funds available for you. So it's a great time to invest in technology, not just AI, but a whole number of other areas are very, very strong right now.
Right. So, it's always good to have a, kind of like as a chief mentor, I guide my students, whether it's a teenager or 50-year-old CEO, to have a visionary story, right? Visionary direction. And pragmatically, when you build a company, it's about, of course, making an impact, the problem you solve, but also going to be pragmatic. What's your actual exit strategy? Well, there's like 4 types of exit strategies, right? IPO, DPO, M&A, or secondary, or bankruptcy, or strike out the 5th one. And the good news is that I believe that with the post-election, the M&A market is going to come roaring back. It's very exciting. I believe that a golden age has begun already here. Now that said, let's move on to the next question. My observation is that, I got so many friends that are in various categories in asset management, investment, and all that, VC, angels, family offices, et cetera. But the fact of the matter is that most VC funds kind of a little bit underperform, honestly speaking. And then even the top 5%, they are probably 3-4x in 7 years or something like that. So right now, with AI being so heavily, in people's heart and mind, and the new fashion now is AI agents. And certainly as an entrepreneur, I encourage you to really try to there's so much money out there. And so I encourage that. Now that said, I'm curious, my panelists here, what's your own asset allocation strategy as an LP versus direct? Of course, at the end of the day, when you look at the center coins out there, the decacoins out there, center coins are the ones that are $100 billion market cap or higher, and then the decacoins are the tens of billions of market cap or higher. You look at the super wealthy investors, like the billionaire investors, they typically went in early and they place a bet on the people, on the idea. There's not much DD they could do except, their imagination, look at some data, right? So it's really placing the right bets. I guess I'm gonna start with Matt, or start with Michael, as you raise your hand. What's your strategy? Okay, great.
So the reason I just raised my hand because I literally have my asset allocation. So, and I have a way to compare my asset allocation against like Harvard or Cambridge asset allocations. But just we're private equity 17.2%, hedge funds 15.1%, real estate 14.5%, venture capital 12.5%, angel and direct 9.8%, kind of heavy for a family office, I think. Operating companies 8.4%, domestic equity 7.4%, fixed income 5%, cash 3.3%. stuff that it doesn't matter, like, you own a car, like 2.5%. Private credit, we're very low on, 1.3, so we're changing that. Foreign equity, I sold almost all my foreign stocks, and I was really happy I did that, so down to 0.9. Commodities, 0.9. I have someone that does it for me. If you ask me any questions, I have no clue what they're doing. Crypto, 0.7, and art and collectibles, 0.5. So what I'm in another group called Tiger 21, and depending on your group, it's very group dependent, but I'm in a group of a lot of very, very successful finance people, and they've always helped me think about how I do my asset allocation. And if you think about what I was saying there compared to, say, like a Harvard was way heavier in hedge funds, way heavier in VC, and way heavier in foreign equity, right? And so when I look at our world, what we've done, just so you can kind of like get a sense of it, is that we've decided to be like, okay, I kind of showed you, like, my private credit's really low. So what are we doing over the next 3 years? We're going to try and find 10, 12 private credit funds to get into to start kind of like managing that. So the reason I just kind of put my hand up there was that one of the things that I found is when I have my AI and my tools, then I'm the captain of my ship. You should have seen me in 2016. You would have asked me that question. I would have been like, give me 3 months, and then I can answer that question. So one of the things that I think around how we think about assets and stuff is, if you don't have tools that tell you right away what's going on, I don't know how you're going to do it, because the world's always changing or whatever.
I mean, your first question about investing via VCs, right? We don't do it today for a number of reasons. Number one, we see a lot of direct deals. We're here in Silicon Valley, and so we can do a lot of direct deals ourselves. I enjoy doing that. I have the time to do it. If those constraints change, then it's a different story. But I think over the last 5 years, maybe 10 years, interestingly, I see everyone in there. So many entrants into a world where I think one would need to be a financier. You want to be you can't just sell a company today and tomorrow decide to be a VC. Being a venture capitalist has a lot of regulatory requirements, responsibilities, and you're a true financier at that point, almost like a banker. And so I'm just surprised to see such low barriers to entry to venture, and that just makes me cautious about that whole area, especially the emerging manager space. In the established funds, on the other hand, we see old fund structures, the 10+2, which then becomes 14, 15 years, and a thesis that's sort of set in stone from the beginning. But now things are changing so fast. I'd like to see, we enjoy more thematic investments because things emerge. For example, there was this, the green tech space didn't really do very well, but there's new chatter about smaller nuclear generators or power plants and so forth. So that's on our radar. We could do something there. Longevity we haven't done, but we're very keen on healthcare AI. Hardware, we did, we did a company on the photonic computing platform, and they're doing very well. But we also invested in a quantum computing company. I think quantum computing might be right around the corner. We don't have to wait 20, 25 years as long as we waited for the CPUs, for the GPU to come. It might be a new technology. So because of that, I think, next year we might see new themes, new theses, and go into my portfolio. If I am already allocated so much to the venture asset class, then it would be very difficult for me to change. But as my friend here mentioned, I think even if you're not a family office, or it doesn't matter, how much savings or what have you, to form a portfolio, to understand your portfolio, break through and come up with a view around your appetite of risk for every asset that's in there, but more importantly, to balance it. As my friend was telling me, I thought they were a little bit low on low allocation to private credit, and he knows it, so he said, well, we're looking into it. But he would have never known it had he not have the tools, or at least breakdown of what it is. So, across family office, we're seeing about, 10 to 15% allocation to fixed income. But of course, that also ties into your liquidity needs and so forth. So that's a whole separate discussion. I encourage everybody to invest based on an asset allocation outlook, and that's driven with where you are in life and you and your family's cash requirements. And then, whether it's an endowment or family office, they essentially do the same thing. They just have a bigger number to play around with.
Let me add a couple of stats that I read. There's like $3 trillion now in family offices, going to $5 trillion by 2030. It's incredible. The major private equity venture firms have figured this out. They now have folks in the investor relations, or they use placement agents to go directly after family offices, high net worth, ultra high net worth. That wasn't the case before. So you can get into the Blackstones, the Starwood Capital. You can get into many of them actually go through various investment banks as well. So they go through investment banks. They go in direct. Many Silver Lake, another one. So sometimes you can go very, very direct. Sometimes you go through a conduit like iCapital. But it's a big trend going on that they realize there's so much money now with ultra high net worth folks and family offices that they're now addressing this directly. So you can get into funds that you may not have thought you could get into before. So that's, and so when I look at myself, a lot of my wealth is now as well in private equity and venture capital. And a stat from, I listened to Stanford's endowment report the other day. 38% of the endowment is in private equity, which includes venture. Over the last 5 years, it's made a little over 17% compounded. Private equities have made around 10%. So they've gotten 6 or 7% more by investing in private equity. My sense is that will continue the case, more so, if I had to say, in pure private equity versus venture for a while.
All right, we have only about 4 minutes left. So let's shift gear a little bit. My last question. We could talk all day long. There's so much stuff we go deep on, right? Human capital, guys. Human capital. Next gen. Ken, what are your viewpoints on, my friend that they call our co-founder, human capital is more important than financial capital. It's a metaphor, probably. What's your viewpoint?
Well, I don't know where to go with there. I thought I talked enough already. I guess I'll talk some more. No, I was thinking about before, we happen to be right now in the midst of technology, human capital. If you live in the Boston area, even Florida, everyone talks about Florida, Texas, all these other places, there isn't the human capital that exists. And so many and I read about it, so many of my friends, because I've been in so many technology companies, you get into deals that aren't, they aren't disclosed, they aren't marketed. It's the human capital that exists in this valley. It's why you see now San Francisco is back in the forefront of AI. So one company leads to another. Interestingly enough, I know actually Lena Khan tried to stop it, and actually in this case I would have agreed with her. Non-competes in the greater Boston, in Massachusetts, not Boston, but greater Massachusetts, they have non-competes. Well, guess what? What that means is harder to start a company when you leave the EMCs of the world. Where in California we don't have non-competes, so you see people leaving the Googles, the Facebooks, whatever, Microsofts, to start new companies. So we have a plethora of again, I'm not sure if this is exactly what you're going for, but we have a plethora of talent here that is very entrepreneurial in spirits, and many of you raise your hands about that. So I just think this is a great place to be if you want to be in enterprising companies. And the other thing I would say is, I'm just going to come across wrong, I know, but when people look at the work-life balance, when you do startup companies, the way that balance works is a company comes first, their family comes second. I know that comes bad. You go in other parts of the country, it's just the opposite. People just have the entrepreneurial passion to make things happen and give it everything they have, sort of like Steph Curry last night. If I can use a nice analogy. So I just think that's what is the benefit, if you will, of living right here in the middle of Silicon Valley.
I just want to add, I think Ken's 100% right, but I've always thought of it from like an artist's perspective. Like the artist is like, I want to paint all the time. What do you mean don't paint? I want to write my poems. So like if you're not like that, I don't think you should be trying to found a company because it is an all-in time. But I've never come back and been like, oh, this is my work-life balance. I've been more like, okay, everyone's asleep. I get to do this now. I'm super excited. So I think if you come at it that way, I think it's a little different. My perspective on human capital is like think of it this way. Like I only came to America 9 years ago. I was a Canadian entrepreneur. Of course, who bought all my companies? An American. And like, I want to be here. I'm finally now at 9 years, maybe like 1 degree off the bottom of the barrel to get the first phone call on the human capital side. Why would you not phone Ken first? Of course you should, right? So now I'm kind of like, whoa, we've got like 1 million left. Phone that Canadian guy that's like more patriotic than the rest of us. So I just want to say like the human capital part is massive. And so one of the things that I did, and just to share with you, every time I got a deal, even though I didn't like it, but I liked the person, I said yes to increase my accessibility over time so that hopefully by 10, 12 years, I'll be on that first phone call because right now it's not democratized. Now, I hate gatekeepers. So if you think about like why I love the internet, why I'm allowed to do anything, is because no one told me no, right? And so I can't wait for it to be more democratized because wouldn't you want to buy Microsoft if you loved it at $130 million? Even better in the early stage. But I'll give you guys examples right now. Yes, I got into Stripe, but when did I get into Stripe? Like 45 billion. When did I fall in love with Stripe? Like 10 days after they launched. How many times did I try to get into Stripe? I don't know, 55. And then I finally got into Stripe as an example, and I love that company. And the way I got in, I'm already knocked out. Okay, so I'm in and out in 2 years, made like 2x or whatever, 1.8x. But I didn't want to sell. But just the vehicle I was in, they chose to do, so I got knocked out. So I think the human capital part's amazing. But then I think when you flip it back on the founder side, if you think about any time we're going direct, it's all because of the human. The only constant in the business is the humans. Right? The business will change, the market will change. So to me, it's all in the human capital.
You know, I think when people say human capital, I have to be careful if I understand it very well, but there are some groups that try to actually quantify that. State Street does the research. I think I mentioned the overall size of the marketable assets around the world, so maybe about half of the 1.6 quadrillion sometimes mentioned as, you know, the value of the human capital, and then some people calculate different values and valuations around it. But on the softer side of things, from entrepreneurial or working with a founder or working with anybody or even interpersonal relationships, you know, Warren Buffett always says it only takes 1 0 to multiply, no matter how big that number is. You multiply it with a 0 one time and you end up with a 0. And so human capital, the human element, I guess if that's what you're talking about, Jason, it is difficult. I think it's limitless. It could take a company from 0 to billions to trillions. We've seen it just with NVIDIA or any other company here. It's all human. Human beings built those companies using tools. We first built tools, then we use those tools to build companies, build other things. And so I think their trust and the intangibles that I struggle to calculate come into play, but nonetheless, that's the reality of life. So as for all the entrepreneurs here, I salute each and every one of you, and hopefully you, whatever journey you're on and whatever door you guys go through, and it would be limitless, and your capital grows from there onwards for yourself and for your family. So thank you.
All right, okay, I'll close it off with 1-2 minutes. You know, the most important thing is kind of like what Jeff Bezos mentioned. Your most important skill is really your intellectual humility. What it means by that is that you got to be pragmatically humble and improve and learn and improve all the time, okay? So really check out ego, check out pride, and really work, if your spirit's not there, work on your spirit, get some coaching. work on your spirit, work on your mindset, work on your skills, especially your soft skills, okay, and your strategies. Like for me, I'm running 2 companies, no problem. I still get my net sleep of 8 hours on average, despite busy schedule. With experience, and observation and learning comes wisdom. And it also kind of work in your fitness, your diet. Everything matters, right? So it's kind of like your visionary story, your emotional, mental state of mind management, your interconnected strategies, your soft skills, critical thinking, problem solving, decision making, curiosity, lifelong learning, communication, collaboration, people skills, those are essential. And check how's your resilience level, how's your adaptability level, how's your tenacity in the right direction. The worst situation is that you're tenacious in the wrong direction. That's opportunity losses, and it's gonna cause you pain. Okay? How's your compassion? Those soft skills are hyper important. And of course, the smart entrepreneurs, the smart SFOs, the smart VC firms would hire carefully, but if you have to, fire quickly, with compassion as well. That said, thank you very much for this opportunity to contribute. Thank you, panelists. I hope it's been useful. We did not even have time to talk about how we could use AI to augment our work, but I guess next time. Thank you very much.